Hi everyone, this is Sandeep. Anand. Stock market is a place where all the participants are constantly chasing the next big wave or the next big trend or the next big stock idea, trying to predict and time the market all the time, which is really a futile exercise if you really think so. The reason for doing this and trying to time the market is really because of a lot of deluge of news that is flowing in day out on the media, on the social media, everywhere, and trying to switch the lanes between cyclical and secular value and growth is really going to impact one's long term returns if you're a long term investor. So, here are top 10 stocks on the screen in 2020. Okay, these are the best performing stocks in 2020 in US market. Look at the companies and the sectors, right? You have Bit Digital, which returned 38 times. Right Blockchain, crypto, which is up around 15 times. Marathon Patent, which is up around 12, 13 times. All three crypto plays. Then you have Novavax, Vaxart, Cardiff Oncology, Trillium Therapeutics, all four from the biotech and pharma space. You have Blink Charging, Beam Global, and Neo, all three from electric vehicle space. It's it's up anywhere from 13 times, 12 times, all the way up to 37, 38 times. That's the stupendous returns these stocks have given in year 2020. Now look at the rightmost column. In YTD returns in terms from January 2021, all of these stocks, 70% of these stocks have negative returns, and that too in a very painstaking way. They have fallen anywhere between 30 percentage all the way up to 71 percentage. Now look at this chart. These are the best performing stocks in 2021 in US. There are around 12 stocks or 13 stocks out there. I just pulled in a top ones. And you could see the returns in 2021. The top performing stocks are L Brands Incorporation, Gap Inc., Marathon Oil Group, Nucor Corp, Diamondback Energy, Invesco Limited, Mohawk Industries, Tapestry, Capital One Financial Corp, Wells Fargo and Co., Freeport McMoran Incorporation. So these are the set of stocks that's best performing in US in this year, 2021, from January onwards. Now, the interesting thing here to notice is 95% of these stocks, which are the best performing stocks in 2021, had negative historical returns in over a long period of time, that is averaging between 5 to 7 years, ranging all the way up to 15, 16 years. Now look at this best performing Nasdaq stocks in 2020. Some of the big names there out there, they have fallen from the grace. Let's look at them. The YTD returns, I mean the returns in 2020 for all of these stocks like Neo, 12 times in 2020, Tesla 8.59 times, Zoom 4 times, Peloton 5.3 times, Etsy 4 times, Fastly 4.3 times, Square 3.5 times. All of them have returned anywhere between 4 to 12 times. These are big companies. I mean, these are pretty good scale companies, and they belong to the sectors which are been the most happening in last year, which is electric vehicles, digital and technology space, digital commerce, e-commerce, tech, payment space. All of these companies were doing primarily driven by innovation and technology were rocking last year in 2020. Now they went up a lot, and look at the fall from the peak in 2021. In the last 6 months, how these stocks have fallen. I mean, Neo has fallen 63% from peak, Tesla 30 percentage, Zoom 41 percentage, Peloton 34. Etsy has fallen half, I mean 50 percentage almost. Fastly has fallen 63 percentage, Square 20 percentage. So these are few of them I put in. There are many Nasdaq stocks out there which has fallen like 50, 60, 70 percentage. Now, what is the point I'm trying to bring home? It's just that imagine an investor's journey through this period, right? And in US, if somebody's invested in any of these markets in last year, say September, October, people look at the rear view and see these stupendous returns given by these stocks, and they would have started investing continuously, trying to catch the tide, from September, October, November, December timeframe. And at that exact peak of time frame, the stocks have fallen 40, 50%. Correction was brutal, right? Now, the same thing is happening in this year. Now let's go back to the previous slide. Now, if you're an investor in US, what typically they do is, you get the screeners, you filter out the best performing stocks YTD in US in 2021, and you would look at the stocks. You will get this list out there on the screen, and it's interesting. Most of these stocks are like from the retail, energy, and commodity space, cyclical space, and industrial space. And the idea would be like, people will be tempted to move switch lanes from the tech, because tech has been underperforming in your portfolio. You will try to catch the next tide of cyclical and commodities. You'll try to buy these kind of stocks. Now, on the screen is just to indicate the point that it's not only the US phenomenon. It's not only happening in US here. It's happening across the globe. This trend is developing across the globe. You could see the best performing stocks in India. I just pulled out a list in 2021, the 5 or 6 stocks out there. Now you could see Adani Total Gas, which is energy sector, Adani Transmission, which is a power company. Then there is Adani Industrial Company. There is Hindustan Copper, which is a commodity company. Then there is Balaji Amines, which is a chemical company. There is Tata Steel, BSL, which is a steel company. So same stories happening out there in India. If you can see, all the companies are either from commodity sector or industrial, chemical, energy, same trend. I mean, globally, if you take a pull up a similar set of stocks from UK or Brazil or China, it's the same story happening everywhere. Now, there is a cyclical turnaround potential, and there could be a lot of derating that's happening to the tech and biotech and pharma space, which might be a possibility. But interesting thing here is, again, if you see historical returns, just the way we saw in US, these cyclical stocks, historical returns of these set of stocks on the screen in India, 94% of them had zero historical returns over a long period. Same story again. Now, if you're an investor and you track, news daily with the media, social media, Wall Street analyst reports, it's very obvious. Like, look at these. These are the set of news articles, headlines that has come up in the last 6 to 9 months, because Wall Street is built on activity, and trying to time the market is what makes the money. So for makes the money for the analyst and the brokerage houses and everything. So you can see that these kind of news is out there. Like, is it collapse of growth tech stocks? The most happening news was that, and comparing with the ARC Innovation Fund falling a lot and all sort of news out there. Then there is another news. Is it the start of a new commodity cycle? That's a big headlines this year. Is it the emerging markets new dawn for the next decade? Then there is news about, should we switch to reopening trade? Should we have them in our portfolio to get the alpha? Then there is news about, is it time to switch from growth to value stock? I really don't know what's the difference between growth value stock, because growth is really part of the value. Then there is it inflation driving down the growth stocks? Is it too late to buy value stocks and commodity cycle? Is it too late to enter there? So all these kind of news is continuously thrown at you daily, and you have to analyze these news along with the performance of. If you put a screener and you see a performance of the cyclical stock the way you saw in the previous slide, it is really going to overwhelm the investors who will not be able to take a decision on how to adjust the portfolio accordingly. So investors always make this mistakes of rear view mirror approach. What do you mean by that? Just the things I showed you on the screen. First thing, looking at the stocks which are hot in news, which are driven by the momentum. The screeners can give you the hot happening industries, most happening stocks that has given huge returns the last 6 to 9 months. People tend to take that as a prologue for the future returns. They continuously keep churning the portfolio, moving in and out of stocks. There could be great winners in your portfolio that you might to sell out early, trying to time the next or catch the next big cyclical stock out there. You might end up selling a great winner, compounding winner there, and switch to a steel stock or a copper stock, trying to get the next big returns. And the other trend I've noticed is people create a big, wide, diversified portfolio of 50, 100 stocks. Obviously, if you have to play all the trends out there, you need such a big, diversified portfolio, so many number of stocks, because otherwise you cannot play all the trends out there. Now, another thing I've noticed is following the herd, going with the crowd, following the news and the noise that is constantly there in the media day in, day out, every hour, and trying to buy every stock out there, possible, what is recommended to play all the trends possible. This can only impact your long term returns. So, the biggest advantage we individual investors have is the time duration in hand. We are under no pressure to have allocation to all the sectors and industries. We are in no pressure to compare our performance every year with a fund or a hedge fund or mutual fund. We have no binding pressure in terms of rules that you need to have only so much percentage in a stock, the maximum percentage is so much, etc. For us, it's very simple to create long term wealth. Create a portfolio of 5 to 10 stocks if you want to diversify. Hold great businesses which are in secular growth trends, which means they are continuously growing ahead, which has a long runway ahead, which means that the total addressable market is so big that they continue to grow for a decent valuations with a great business model that is usually capital light or asset light and driven by great management. The job is done. The most important thing is to cut the news and the noise out there so that they don't influence and change our minds, and we tend to churn our portfolios because of the news. So thanks for staying with me and listening me out. Do subscribe and see you again in the next video.